I'm Ryan O'Connell, and in this video, we're going to be going over 3 different types of portfolio construction. The first is long-short, the second is long extension, and the next is market neutral. We'll go through each of these portfolio construction methods one by one, starting with a long-short portfolio. With this type of portfolio, the manager's typically going to target a gross exposure of about 150 to 200%, and a net exposure of about 0 to 60%. The gross exposure would basically be the percentage that the portfolio is long plus the absolute value of the percentage that the portfolio is short, right? So that is the gross exposure, whereas that net exposure would not be the absolute value. It would really just be the short percentage if the short percentage was a negative. So if you were 50% long and then you were 50% short, then your net exposure would come out to about 0%. So long and short positions are relatively unconstrained. So of all of these 3 methods that we're talking about on this slide here, this one is going to be the least strict on position sizes. So some of the other methods are going to have not allow the manager to fully express their own views, where this one gives the manager the most flexibility. So can be long or short depending on the portfolio manager's views, so very flexible, and the manager has the most flexibility in order to use their views to try to generate alpha for the portfolio. The second type is a long extension portfolio, which is a enhanced active equity strategy. So we're going to be looking at a portfolio that is constrained but has both long and short positions. So this would be a hybrid type of portfolio between the long-short portfolio that we talked about up here already and a long-only portfolio, which is a portfolio where the manager can only take long positions, 0 short positions whatsoever. So the most common example of a long extension portfolio would be a 130% long and 30% short portfolio, right? So this is a common structure. So if we think about when we were talking about gross exposure and net exposure up here, the gross exposure would be that 130% plus the 30%, so that gross exposure would be equal to 160%, whereas the net exposure would be the 130% long minus the 30% short, which would get you to a net of just 100%. So with these long extension portfolios, the net exposure is typically going to be maintained at around 100%. It deviates from that long-short portfolio where the net exposure was typically 0% to 60%. So it is basically more long. So allowing some level of having a short position will allow the manager some level of expressing their own views to try to generate alpha, but it is not going to be nearly as flexible as the long-short portfolio allowed the manager to be. So in this hybrid idea, it is less flexible than the long-short portfolio, but more flexible than the long-only portfolio. And the final construction method is for market-neutral portfolios. So in this type of portfolio, we're going to hedge out market risk and other risk sources. So this goes beyond simple dollar neutrality by matching systematic risks between long and short positions. So an example of this would be we want to have a portfolio beta of 0 by offsetting these risks between the long and short positions. So this will gain pure exposure to specific factors consistent with the manager's views. So the whole point really is to focus on the manager's specific skills for the alpha generation while removing any of this noise from the overall market. And this could often be used for absolute return strategies and specific factor exposures. Now, let's look at some benefits of long-short strategies as well as drawbacks of long-short strategies. And one thing I want to clarify is that although one of the strategies on the previous slide was called the long-short strategy, all three of those were technically versions of long-short strategies. So when we're talking about these benefits and drawbacks, we're talking about all three of those methods that we talked about on the previous slide. So let's dive into the first benefit, which is that these long-short strategies can reduce market risk. Now remember that this is relative to a long-only strategy. So long-only managers are typically limited to a total portfolio beta that's going to be somewhere between 0.8 and 1.2. And remember that beta is that systematic risk or market risk, whereas with a long-short strategy, they could have a beta that's actually much lower than this range. Another benefit is that there's more opportunity to capture alpha and risk premiums relative to a long-only strategy. This is because the manager can profit from both positive insights, which would be these long positions, and negative insights, which would be reflected by the short positions. The long-only manager cannot profit from the negative insights at all. And then finally, there's going to be more diversification potential with the long-short strategy than a long-only strategy, because it can achieve a more balanced distribution of risk across different factors than a long-only strategy would be able to. Now, diving into the drawbacks of these long-short strategies, the first one is that these strategies may reduce market return premium relative to a long-only strategy. This is because the market has historically provided positive long-term risk premium. The S&P 500 on average has returned somewhere between 8 and 9%. So if you were to go long only into the market, perhaps you'd assume you'd get this long-term risk premium, whereas if you decrease beta, you're going to likely be receiving less of this long-term risk premium. So reducing the market exposure through shorts might mean potentially missing some of this premium. Also, another drawback is that the long-short strategies can increase active risk. So active risk, also known as tracking error, which we've talked about in some of the previous videos, is the standard deviation of the portfolio returns minus the benchmark returns. So basically, we can drive this to increase this difference, so raise our tracking error, which is a bad thing. And why would having more short positions make this standard deviation increase? Well, because the benchmark returns, traditional benchmarks like the S&P 500, don't have short positions within them. So if we start adding short positions to the portfolio, we're going to be changing these portfolio returns without changing the benchmark returns, which is going to drive up the difference between the two, which is going to drive up that standard deviation and that active risk or tracking error. And then finally, these long-short strategies are more costly and more complex than long-only strategies. So they require a relationship with a prime broker. They're going to have higher fees than long-only. And then also, the operations are going to be more complex because you need to locate the shares that are actually going to be shorted, and then there's borrowing costs associated with those shares that are going to be shorted, so a lot more costs involved. You can get 15% off full CFA courses featuring my lecture videos by clicking the link in either the pinned comment or the description and using promo code Ryan15 at checkout.